Let's Talk Money.
Welcome back. You're with us on Let's Talk Money, and this week Devina Mehra is helping us put some rules in place to that whole quest for creating long-term wealth. Devina, so now it's time to ask you for some advice. So I'm going to take an example. Say someone who's in their mid-30s, earning, will perhaps continue to earn for another 20 years and is looking at a holistic approach to portfolio creation. So what is the kind of asset, looking at the market environment today, what is the kind of asset allocation, which markets, which asset classes, what's the proportion? What would you advise this medium risk mid-30s investor?
Okay. So first of all, of course, everybody's life circumstances are different, that how many kids you have, whether your parents are dependent on you, many of those factors come into play.
Absolutely.
But one thing when you're planning for 20, 25 years, which we haven't spoken about till now, is that look at global diversification. That is so important. I give the statistic all the time that when I started working, the dollar was 12 rupees. So it's been
I cannot. What? When you started working, $1 fetched 12 Indian rupees.
12 Indian rupees. So in the
86 something today.
Yeah, so in the course of less than a career, there's been a 90% depreciation. So when you are planning for 20, 25, 30 years hence, this is not something you can forget. So because that your rupee loses value over time. And very often, if anything, hard currency expenses have gone up since then. People study abroad, people's children study abroad. And often settle there. So I hear many times people say that after retirement we'll spend half the year there. So basically your hard currency expenses have been rising, and Indians still do too little global diversification, because when we were growing up there was no option to it. India did not have capital account convertibility. You could not invest in global markets. Now you can. So our grandmothers were right to buy gold, because at that time that was the only currency hedge. But now you have the whole world. Again, people think global diversification means that you buy a NASDAQ index, or you buy the 5 stocks you know the names of, or another 3 Chinese stocks you know the names of. That is not global diversification. Global means global because one golden thing in investing is that themes change. So no asset class, no geography, no sector does well forever. So it, US has done well last 12 years, but there was also, for example, 2003-4 to about 2007, US, and it wasn't coming off a high. It was already in the doldrums after the tech crash. Still, it continued to lag, and that was a golden period for emerging markets. India went up 6 times. Whole emerging market index went up 3.5, 4 times. So you have to have the whole globe as the so that's why, for me, it's a cause. So that's why, we have a whole, all investing across all geographies, all asset product that starts at $10,000, at just 8.5 lakh rupees, which you normally won't get for less than $1 million. So coming back to your question.
So right now, when you want to achieve adequate global diversification in your portfolio, and people, sometimes equated that I'm invested in the NASDAQ, ETF, or I have some fund which is dovetailing on the Dow. I don't know, is that enough?
No, that's not enough. That's what I was saying. US is not the world. So in 2021, if you remember, is when all these NASDAQ ETFs and fund of funds, etc., were launched in India. And not in hindsight, but at that time, I had come on your channel also and said that, 3 years NASDAQ has done brilliantly. Don't assume that this will last. And 2022, NASDAQ was about the worst performing index in the world. It went 40% down from the levels at which those ETFs were launched. And people came to me and said, should I sell now? I said, now that, don't compound a bad buy with a bad sell. Because a stock down 40% can still be a sell. But a major index down 40% is almost never a sell. And so, of course, it bounced back from there. But that's the whole problem with buying very narrow, focused indices or funds, and often it's just a layer of cost getting added at the India end.
So then which are the markets, or where else?
So you have to see that changes. Again, I can't say today that you buy this combination and that will last for 10 years. So that's why we do that. We have a fund and we have portfolio accounts which do that, because that changes, and we look at it every quarter. For example, this year. Now we've gone underweight US, even though it's still large, but we've gone underweight US, we've increased Europe,
Okay.
In China, we've been little overweight from last year itself. India, we are slightly overweight. So that would be, but that changes.
Okay. Okay. So that's global diversification, which is extremely important.
Right. So over time, you should have 30–40% globally diversified.
Wow.
Yeah. So
Yeah,
at least, I mean, logically it should be even higher, but because as it is, you are exposed to India. Your career is here. Your real estate is here. So and people say if India is growing so well, why invest?
Why look at other equity markets?
Yes, but in the 90s, which were the highest growing economies, they were the Asian tigers.
Correct.
And then there was a crisis.
Correct.
And in 1 year, those markets fell between 50 and 90%. And that was a wake-up call for me that if I was an Indonesian, my net worth would have been wiped out by 90%. So that was the sort of one of the triggers why we went global as far back as 1999. We were not just the first Indian, we were the first Asian firm to become a member of the London Stock Exchange, other than the Japanese. So because I realized that putting all your eggs in one basket is not a good idea.
It's not a good idea. Okay. On gold, I mean, you briefly mentioned a hedge against obviously currency risk, etc. But you know, gold is an interesting debate right now. Yes, households probably have enough of it, and there's one school of thought saying don't take overexposure because from your grandmother to your mother, I mean, there's enough gold in the households. But the other school of thought is that gold is rarely sold for emotional reasons or whatever. So, you know, many people say that do you really want to include that traditional old jewelry as part of your gold allocation? Because it's not a sensibly well thought out, balanced financial way of investing in gold.
No,
what are your thoughts on it?
No, whether it was thought out or not, you hold it. So that you have that investment there. So, I mean, there's no reason
but
to
you won't
say
sell
that.
it. That's the point. That people say that it's just notional holding. You won't sell your grandmother's jewelry.
Indians do. I mean, every time gold and silver reaches a peak, Indians are out there selling.
Actually,
I mean, even now the jewelers are saying that buying is not happening in gold jewelry. So I think you should definitely add it in your asset allocation. And many times the grandmother's jewelry, the daughter or daughter-in-law no longer wants to wear in any case.
Could be. But you know, on a steady state basis, obviously it will vary in different market conditions. But roughly speaking, I mean, do you give it 5%, 10% in a portfolio?
Yes, in that range. It should not be 25% of your portfolio. Because gold is an extremely volatile asset. People think it is, it is some sort of a stable asset, but the dollar price of gold in 1980 was not breached till 2007. It took 27 years. In between, it came down more than 60%. 19 years later, it was down 60% from the 1980 level. So this is what people forget. It looks good, relatively okay in rupee terms because it's really a rupee depreciation chart. In dollar terms, it has been more volatile than the S&P.
Wow. That's something to think about. But, you know, finally coming down to some closing thoughts, Devina, and beyond, of course, we've discussed the asset allocation and some portfolio advice. I want to understand from you, when you've observed people over the years, what do maybe the rich do differently, which keeps their wealth growing? Or, you know, should I put it the other way? What do perhaps some middle-income Indians also do differently to break through, to move to the affluent side? What have you observed and what would you like to share with us at a more behavioral or maybe personal aspect?
So one thing is that don't start that so-and-so became so rich and what was the way they went. Because, you know, for example, if you follow a very high-risk strategy where bulk of the people go bankrupt, but whoever survives, let us say, makes their money 10 times in a year. So if you start with 100 people, at the end of 5 years, there might be only one person left, but that person would have really made it out like a bandit. So you think that, but that's not good strategy.
Okay.
So never think like that. So as I said, do the basics right, that save sensibly, invest sensibly, start early, manage your risk, which means don't have too much. I mean, if you're talking of the stock market, don't be too concentrated in certain themes or certain sectors. Always have a stop loss on wherever you are investing yourself. So do all the sensible things. Don't think you will suddenly make it rich. I mean, somebody asked Rakesh Jhunjhunwala also that you made your money from trading, so why do you tell people not to trade? And he says that, you know, I may be smoking, but I tell my children not to smoke. So because it's not a good idea, statistically speaking, to do that. So do the sensible, I mean, good investing can be boring. So it just doesn't sound very exciting that, you know, do asset allocation and do global diversification, manage your risk. and manage your mind. That's the, lot of what I've read in the last few years has been on how many biases and randomness we have as human decision makers, and why those are all very hardwired within us. So you have to
give an example of,
for example, this is
yeah.
loss aversion bias, that we hate to book losses. And a 1 lakh of a loss gives us more pain than 2 lakhs of profit. So don't try to make it up in the same stock or the same strategy. That's another thing which people end up doing, that when the stock comes back to my purchase price, I will get out, because the market has zero interest in your purchase price. So, you should be just agnostic where you make your money.
Okay. Manage your mind, and the money and the wealth will perhaps follow. All right, Devina, it's been a great conversation. Thank you so much for laying out some of the basic rules that we often tend to, overlook or forget. This is a good conversation. Thanks so much for joining us today.
Thank you, Surabhi. Pleasure.
All right. Well, we hope you enjoyed this show, this particular episode of Let's Talk Money. Do give us your feedback, your reviews, and of course, send us your comments, queries, anything else you would want us to talk about. We'll pick it up in the coming weeks. Thank you for watching.
Let's Talk Money